Known as one of the biggest mining companies in India in today's time, Vedanta is a company that cannot be ignored. Founded by Anil Agarwal in the 70s, Vedanta was first a scrap trading business that turned into a mining and mineral conglomerate later on. But now this very conglomerate is all set to split. Recently, Vedanta board approved a pure play asset owner business model and announced a demerger that will result in the company splitting its businesses into 6 different entities. So what will change? What's going to happen to the shareholders? Let's take a look at everything in today's ETMarkets Decoder. I'm Neha Vashisht Mahajan from ETMarkets. Let's start. The first thing to know is the entities. Vedanta will split into 6 entities. Number 1, Vedanta Limited. Number 2, Vedanta Aluminium. Number 3, Vedanta Oil and Gas. Number 4, Vedanta Base Metals. Number 5, Vedanta Steel and Ferrous Metals. And lastly, on number 6, we have Vedanta Power. Now coming to the entities and how these will function. Vedanta Limited, which is the currently listed entity, already has 64.92% stake in Hindustan Zinc and will hold the same. Additionally, it will hold the upcoming semiconductor and display business and also stainless steel business, which is Facor and Nicomet. Next, Vedanta Aluminium will handle the aluminium business along with its 51% stake in Balco. Vedanta Oil and Gas will have Gain India. Copper and Zinc International businesses will be under Vedanta Base Metals. Vedanta Steel and Ferrous Metals will have ESL Steel Limited, Domestic Iron Ore Business and Liberia Assets. Power businesses will go under Vedanta Power. The demerger will be a simple vertical split. For every 1 share of Vedanta, the shareholders will additionally get 1 share of each of the 5 newly listed companies. According to the company, the demerger will simplify the corporate structure and will also help the investors in choosing the right commodity for them. It will also help the company unlock value and potential in each entity along with increased investments. However, we cannot avoid the $4 billion debt that the company has under its kitty. Vedanta Limited's parent company Vedanta Resources Limited or VRL has debt repayments worth $1.3 to $1.4 billion to make it in the next 6 months, including bond payments of $1 billion in January 2024. In FY25, there are debt obligations worth $3 billion besides interest servicing requirements according to various brokerage estimates. As the demerger process will likely take 12 to 15 months to complete, it won't help the parent company to meet debt obligations. With the global commodity markets facing multiple headwinds, including muted demand pickup from China, the likely course of action for Vedanta is refinancing or divestment of stake in Vedanta or individual businesses as per analysts. Sumangal Nevatia of Kotak Equities said, the demerger could make a partial divestment in different businesses easier, which would help VRL in deleveraging. However, the demerger by itself is unlikely to unlock any value in our view, and that debt remains a key overhang and requires divestment of non-core businesses. Ashish Kejriwal and Jyoti Singh from Nuvama also added, as this demerger does not improve Vedanta's credit profile, the situation remains the same for VRL to refinance the debt. Vedanta's cash flows are not sufficient to upstream the dividend to VRL unless it assumes debt on its books. Both Vedanta and Hindustan Zinc paid hefty dividends to shareholders in FY23. Amid a weak commodity environment and increase in interest rates amid downgrades by credit rating agencies, high dividend yields may also come under pressure. Phillip Capital said VRL's main source of income to service debt is brand fee and dividends. However, with commodity prices nosediving, brand fee and dividend will see sharp fall over the previous year, pushing VRL against the wall. The brokerage also said that the VRL will be able to partly pay or refinance its debt at higher cost and will avoid a default, adding that the demerger will provide flexibility to VRL in terms of part or full sale of any particular asset, which will help it to manage its FY25 repayments. The proposed demerger will take place within the next 12 to 15 months after all the necessary approvals from shareholders, lenders, creditors, and regulatory authorities. Well, that is all for today. Stay tuned to ET Markets for more.